Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Currencies are relative. All currencies are priced on that relative basis. So there's a bull market in one currency and a bear market in another. So today, the way I look at the prices in the day, looks like the Aussie dollar was up, but ironically, the U.S. dollar was up against the Canadian dollar. So it's definitely a mixed bag, although the U.S. dollar was up against the pound and the euro. So it's just an interesting day. Aussie did rally. But it looks like Aussie was the big winner. But other than that, the U.S. dollar rallied again. So we'll see what happens tomorrow, which is going to win. You would think that it's going to be the Australian tends to sort of move counter to the U.S. dollar. But again, today was sort of a strange thing where the U.S. dollar was up against everything, but against most currencies, but not against the Australian dollar. When an economy expands or contracts, supply and demand is out of balance, so markets are not perfect. Theory says is that the markets are always going to be in balance. In fact, it's impossible when you think about it. So that gives us an opportunity to trade. Currency markets react to supply and demand distortions. Capital is extremely mobile. We saw that this morning and even in the afternoon here on June 21st, summer solstice in the Northern Hemisphere. That we saw risk appetite early on the trading day and then risk aversion sort of later in the day. Capital tends to go where the best opportunities are, at least perceived opportunities. Current account, capital account, well, the balance of payments, BOP, is an accounting record of all monetary transactions between a country and the rest of the world. Currency markets watch this current account for potential indications of competitiveness. Current account shows the value of goods across borders. Some would say the current account is really not the best way to look at what's happening now. The capital account is the change in foreign ownership of domestic assets, less the change of domestic ownership of foreign assets. So some would say the capital account might be a better way to look at it. The capital account is foreign direct investment plus portfolio investment plus other investment plus reserve account. That's just the definition of it. Money. Money has a price. It's measured by currency rate and interest rates. Currencies price money across borders. So why would you import? Well, business has needs. Maybe there aren't any alternative goods. Country might not make a certain product. Citizens have currency to spend. Research and development can be done at home. Manufacturing done abroad. I'm sure that all of us can come up with a lot of examples of that. Why would you export? Well, natural resources that are abundant. So you might think of a country that has a lot of natural resources, such as, let's say, Australia, maybe even Canada. Citizens do not have currency to spend, but that's, of course, probably more so in Australia, where they have many, many resources and fewer people, really. Greater demand for their goods abroad. Currency exposure, the value of the dollar relative to other major currencies around the world, is one of the most overlooked contributors to investor returns. Especially today, due to globalization, investors are no longer just considering domestic equities and bonds, but we have to also consider the effects of currencies on their portfolios. So I took a screenshot this morning of large cap stocks, 52-week performance. Notice a lot of ADRs are on this list. So out of 20 stocks, we see 1, 2, 3, 4, 5, 6, 7, 8 ADRs. And these are poor performers. All right, the first one, Nokia, probably doesn't have anything to do with currency. Lloyd's might. BP obviously doesn't. No More probably doesn't. But then when you start to go down to ENI, National Grid, France Telecom, and Total. I would assume that some of that 52-week price, that decline in price, has to do with the currency itself, the fact that the dollar is stronger relative to the foreign asset. I wrote an article, Why Currencies Matter, about a year or so ago. I guess this was, I took a screenshot, August 31st, 2009, and I looked at the 2008 and 2009 changes, and again, if you're looking at the S&P, no matter what it is, right? If you're a U.S. investor, last year at that time, it was up about 13%. 2008, it was down 38%. Of course, it rallied significantly from August on. But what I'd like you to take a look at is, if you take a look at the second row, like the Euro stocks, you might see a 13% nominal rate of return, but a 16%, 0.49% change in 2009. What was happening there? The euro was stronger. 2008, you see a 44% decline, but actually almost a 47% loss because, again, the dollar was stronger. So you'll notice that the effect of currency is substantial. Look at the FTSE. I mean, it's amazing. In 2008, FTSE index was down 31.33 in nominal terms, but adjusted for the weak pound, British pound, U.S. investor would have been down about 49.5%. Now, of course, you might say, well, if I'm going to stay invested in the UK forever, that really doesn't matter, and that is true if you're going to stay invested, but most of us are probably going to repatriate our money, and when you do, you need to consider the currency, the currency's effect, because, again, it's huge. Let's go down to the Australian dollar. I'm sorry, the Australian ASX. And if you'll notice that last year, the ASX was up about 20%, but if you were invested in Australia as a U.S. citizen, what you're looking at there is about a 44% increase. 44%. Why? Because you had your investment in Aussie dollars, essentially. Now, of course, there's always a flip side. The flip side was the year before, you had a 41% decline, but in Aussie dollars, you're really down 53%. So what does it all mean? Well, what it means is that a lot of us have investments, quote unquote, overseas, and you might really feel strongly about those investments, but you might want to hedge a bit of the currency exposure if you felt that you might want to give yourself the flexibility of selling it over a shorter period of time, let's say, X number of months, maybe a year. You weren't going to stay as a very, very long-term investor. Only options give you the hedge. And then that's what options do in general, whether you're trading an ETF, an equity, you get that hedge. So you can get the same thing here. And this slide really, I think, does a great job of explaining why you might look at these currency options. And again, they can augment your risk tools. And it's just that simple, is that you don't have to be trading spot each evening. You don't have to trade futures. You can buy a limited risk option to give you the ability to hedge, or you might, if you had a view of the Aussie dollar, or Canadian dollar, or whatever, you don't really care about the impact on your portfolio, you can trade the options also.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.